Hey, what's happening once again, options traders? And I've got another good question for the group here. Talking about the net contract exposure. And if you're not sure what the net contract exposure is, it's a fairly handy little quick calculation you can do that can give you some very good insights into the risk of a position. And not only that, you can get insights into how those positions are going to change if the stock goes up or if it goes down. Now, this question came to me, or at least this video was in response to a question that somebody had asked about the covered call. And their question was, let's say that we were doing a covered call where we buy 100 shares of stock and we could choose to sell the at-the-money $100 call, which has, let's say, roughly 50 deltas. However, you could also sell two, let's say, of the 110 calls that might have 25 deltas each. So if you sell off two of those, it would also be 50 deltas. And sometimes this is a common strategy during high volatility where traders will say, well, instead of selling one $100 call, let me sell two of the 110s. I've got the same number of deltas, but now I'm selling off two options instead of one. And if there's some high skews, I might be even better off by selling these out of the monies. Well, the question is, are these the same positions? And this is a real good example where you can use the net contract exposure. And so here's how it works. You're just going to simply count the total contracts. So let's say that you're long 10 $100 calls and you are short 10 105 calls. Now, many of you might recognize this as being a vertical spread, but one way you could figure out the risk in here is to say, well, in the first position, I'm long 10 calls. In the second, I am short 10. If we combine them, I've got 0. So that tells me I've got a net contract exposure of 0 if the stock goes up above 105. I'm going to be long 10 contracts and short 10, so there's no risk to the upside. I can also tell that if the stock falls below 100, both options expire worthless, in which case I have no deltas as well. So even though I might not know the exact shape of this risk graph, if I just know the net contract exposure, I can tell that to the far right, I'm going to have a flattened portion of that risk graph, 0 deltas, and if the stock is below 100 or to the far left, I will also have 0 deltas. So this is the risk graph of that position. And of course, depending on what we pay for it, we'll shift it up or down, but it will always have this same shape. So keeping that in mind, let's go back to the question about the covered call. So if we buy 100 shares of stock, we know that that's 100 deltas, right? Shares of stock always has 100 deltas. It's always gaining and losing dollar for dollar. So if you have 100 shares, that is 100 deltas. If you sell off the $100 call, you are also selling off in total 100 deltas at expiration. So again, I can say that if the stock is above this strike, above the 100 strike, I have 0 deltas. Now I could also look at it in terms of contracts. I could say that 100 shares is the equivalent of one call, or each call represents 100 shares. So I could look at it as though I'm long a contract and short a contract. But the point is that I have no exposure above the strike. Now, what about below? Well, if the stock falls below the 100 strike, I still have 100 deltas from my shares. Doesn't matter how far the stock goes, it goes all the way down to 0. You still have 100 deltas. But for the call option, you end up with 0 below 100. So if that stock price falls below the 100 strike, you're going to have a net 100 deltas. So just by using this net contract exposure, I can tell that below 100, or whatever the strike is, I'm going to have 100 deltas, and above I will have 0. So again, we're just saying the short $100 call, everything above that should produce 0 deltas, but everything below will give me long 100 deltas. So just by looking at that simple calculation, I can already tell that this is the basic shape of this graph, this darker blue line. We've seen that before in many videos. This is a covered call, but this lighter shaded one is what's called the current curve. All right, so this is what it looks like today, and over time, this lighter curve moves towards the solid one. So now let's go back to this question about the covered call. If we buy 100 shares, again, got 100 deltas, check. But for the current curve, we have to do things a little differently. if the $100 call has 50 deltas and the 110 call has 25 deltas, I could just look at these in terms of deltas as well. So if we sell one $100 call that has 50 deltas, and if I sell two 110 calls that will also have 50 deltas, yes, that is true. At that point in time, right now, I will have the same deltas. But we have to figure out what's going to happen at expiration. And again, this is where the net contract exposure can come in. So let's think about the expiration graph. What's going to happen now? Well, now I can see that I am long 100 shares. And in this second position, if I choose to sell two of the 110 calls, I'm going to have a net contract exposure of minus 100. And that's again because I'm long 100 deltas with my shares, but I'm short 200 shares by selling these two 110 calls. Now, to be clear, this is at expiration. Right now, at this moment, I'm only short 50 deltas. But when we get to expiration, I will be short 200. We couple that with the long 100 over here, and I can see I'm going to have a very big risk. I've got naked 100 deltas or 100 shares to the upside. So this is what it would look like. So here's the risk graph for the covered call that we saw, the darker line, and the lighter blue line is the current curve, and in red is the current curve if we sold two of the 110 calls. So notice that the red and the blue, the lighter shaded ones here, cross at 100. And that's because at this moment in time, they both are equal to 50 deltas. So if we're long 100 deltas with our shares, we've sold off an equivalent of 50 deltas. We're long 50 deltas, whether we sold one of the 100 calls or two of the 110s. But as we get closer to expiration, and if that stock price keeps rising, look what happens. See, that lighter blue one goes towards zero because we're long 100 shares and equivalently short 100 by selling off one call. And that's why the blue line flattens out at 0 deltas. But look at the red. See, we're starting to head over here towards minus 100 deltas. So if we looked at it at expiration, if we're long 100 shares and short 2 calls, there's our expiration graph. It's going to be a short straddle, synthetically the same thing. So what's interesting about this is it really depends on when you're talking about the risk might appear. Right now, today, they are exactly the same. Selling off one 50 delta call or selling off two 25 delta calls. So yes, right now they're the same, and that's what this person's question was. But we can't just stop our analysis here. We have to say what happens as time goes by and what happens if the stock price goes up, what happens if it comes down. We have to stress test this. And so this whole idea of net contract exposure is a real simple way to be able to visualize a fairly complicated graph like this by saying, well, if I buy 100 shares and I sell 2 calls, doesn't really matter how many deltas you have today. We know that at expiration, and if that stock continues rising, you're going to have short 100 deltas up here at the far right side. So I hope that helps you to understand what can sometimes be some complicated graphs. Just add up your total calls or your total puts, understanding that puts have negative deltas. And if you have 100 shares of stock, that's always going to be 100 deltas. So play around with it and you'll start to get the hang of it, but it's a real good way to do a rough check, especially if your broker's platform doesn't allow you to do risk graphs like this. But it's a real good way to at least get a good visual of any hidden risk that you might be overlooking. And so for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.